Hello and welcome to Livewire's Income Series for 2025. My name is Chris Conway. Today I'm sitting down with Roy Keenan. Roy is the co-head of Australian Fixed Income at Yarra Capital Management. Roy, it's great to see you again. Thanks for sitting down with Livewire.
It's always great to catch up.
Roy, pretty good timing. We recently looked at the best performing Aussie income funds for FY25 in the Livewire database. Yarra occupied numbers 3, 5, 6. With the Higher Income Fund, Australian Bond Fund, and of course, your Enhanced Income Fund. So first of all, congratulations, but just how have you managed to achieve the results that you have?
Oh, thanks very much for that. Look, they are great results, something that we're really proud of. You know, firstly, I'd say I'm a bit sort of upset that out of the three, I'm actually running last as the portfolio manager. Phil Strano manages the Higher Income Fund, Darren Langer, the Australian Bond Fund, and myself with the Enhanced Income Fund. So yeah, I am a little bit upset that I'm running third out of our three, but look, totally, you know, I'm absolutely wrapped with that outcome. I think in some ways it goes back to the processes that you've set up. The team's now been together for some 4 years. I don't say team lightly, we are a team. Yep. We have individual portfolio managers, but the way we've set up our business is for team success. Not to mention the support we get from Tim Toohey, our macro strategist, how we work really closely with our equity team from a credit viewpoint. I think those sort of results are a sort of culmination of everything coming together.
Yeah. Roy, I'm just going to pull on that thread there a little bit. You and I love talking footy and we understand the importance of team cohesion and things like that. So how does that manifest? Is it just the way that you share information with each other, you challenge each other? Is it those sort of things that drive that performance?
Formally, we have a daily meeting, right?
Yep.
And we talk about all the issues, and it's an open agenda in our fixed income meeting. We debate our positioning. We talk about, you know, where's the risk of not picking up some sort of return. You know, something probably in my past I learned from Goldman Sachs when I was there at Goldman Sachs Asset Management is that, you know, you should be questioned and the position is questioned, and our whole team contribute to that. So I think it takes time for the team to bond together. Yeah. But you're right, you know, you can't have your gun on ballers and your defence is hopeless, right? Yeah. You need everyone pulling together, and you know, I think the results speak for themselves.
Yeah, no doubt. Roy, you and I spoke on the rules of investing in February. Some prescient commentary from you talking about how everyone was underestimating Trump. So you nailed that. He has caused a lot of volatility. So where are we now, and what's some of the outlook for the next 12 months?
Yeah, I think even I'm glad I was on record mentioning that, but yep. Even probably I underestimated how much volatility caused in the marketplace and how aggressive he was on the tariffs. Look, I think there's still a long way to play out here. I don't think the markets have fully reacted to what Trump's tariff policy is. Some of his policies, his fund, how is he going to fund his budgets? The amount of supply of bonds that are going to come. Time will tell, right? The economic data will tell us how a lot of the decisions have been made in the last 3 to 4 months, where they will fall. And I'm pretty convinced we'll see a little bit step up in inflation off the back of the tariffs. We'll see growth slow. And ultimately, you'll get risk markets adjusting to that. I think we're all trying to speculate at the moment and so sort of think about what's happening, but the data will tell us in the end.
Yep. So just on that, I mean, it's hard to, like you say, think about what could happen. The range of possibilities is quite vast, but let's just take your base case. If that plays out, what are the biggest risks and opportunities for income investors?
Oh, look, no doubt. I think the biggest risk for incomes, and you generate income from investing credit, right? Yep. So the biggest thing that I'm always worried about, especially from if you rule out shocks that we can't see, the biggest thing is growth, right? So why it's very low probability, and it was getting high probability in April. Recession's the worst outcome for us. So we're very mindful of that. When we think about, if recessionary risks are rising, do we increase our liquidity? Do we increase our interest rate duration to offset that? The way I sit today, I don't see those risks there. So in some ways, the risks that could come out of left field are things that we really, like we've seen past with global financial crisis, is the things that coming. And so we're very mindful in our meetings that we were talking about before with our team is we're what is out there that could surprise us? What should we be keeping an eye on?
Let's shift focus a little bit, Roy. The RBA recently refrained from cutting interest rates. It was a bit unexpected. I think everyone was pricing in that we would get 25 basis points. What was the House view, and what did you make of the decision?
Yeah, so our view was that they would cut.
Yeah.
Mind you, I've been on holiday, so I was away for that decision. So
Yeah.
how I see this, is probably a little bit different to the House view. I was probably going into it a bit more the like that they wouldn't cut. It was my gut feel.
Yeah.
And one of the reasons being is if you have I think Yarra's view going back last year was they should have been cutting in 2024. So the RBA has displayed in some ways they've been consistent. They've waited for the data, and July would have been preemptive, and they really haven't been preemptive in this cycle so far. So to me, they just want validation from the data, and they've got that with the CPI data last week, which should guarantee the August rate cut. So to me, I don't think it was a big surprise, because I think it still shows that the RBA is a bit scarred from what happened with inflation in 2021 and 22, and they just want to nip it in the bud.
Yep. So net result, if they do cut this month, you think that's a good thing for markets and a good thing for income investors?
Absolutely.
Yep.
Whilst we lose a bit of income from floating rate side, in our funds we've got a bit more fixed rate exposure into the fund that we would normally have. So, and the market's already pricing it in, so it's not going to be affecting our income too much. So it's not a major concern for us. We've got 2 more rate cuts for this year, so August, November, and then essentially we've got another 3 penciled in for next year.
Yep. Roy, let's focus on your fund, the Yarra Enhanced Income Fund. Your last monthly talked about performance being driven by tightening spreads. It's been a common theme for a while. And strong income return. Can you just unpack those drivers for us, and what are spreads, again, what are they telling you about the world at the moment?
So much has happened in the last 12 months, and particularly since Liberation Day in April. What we saw in April was credit spreads and equity market sell-off, credit spreads widened. And in some way that was a big opportunity for our funds. We were able to deploy some cash, we were able to take gains from our interest rate strategies. And essentially what we've seen in our returns, especially they've been quite strong over the last 3 to 4 months, has been as credit spreads have started to rally in, we were able to deploy capital, capture that rally in credit spreads. But at the same time, income has been sort of hovering at around that sort of 5.9 to 6% mark in the fund. So it's been a really good time. It tells you also that there's a lot of more confidence in the market about credit, especially IG credit, where we think is the best value at the moment. Also, it probably it shows you that over the sort of coming months, I think credit spreads will continue to support it. There's a lot of talk about de-dollarization of the US dollar, and the impacts that has on countries like Australia. And our observations in 2025 is we're seeing a lot more foreign demand for Australian credit. I don't see the environment changing for that.
Yeah, right. Roy, I do want to pull on a thread there just for, again, the people playing at home. So when spreads blow out, it's really saying to the world, this is a risky place. And you've got to have the fortitude to look at it and go, hang on, that's an opportunity. So take us into a Yarra meeting that morning when spreads are blown out and you guys are debating, like, how fierce is the debate, or do you just see it as an opportunity? From your experience, you've got to go for it.
So first of all, you're only investing if you like the credit, right? So the
Right.
fundamental work is done on the credit, so we know that. And if there's an event that happens, what's the impact on the credit? If there's no change, then it's a repricing of risk, all right? Sometimes when an event like that happens, it's not about the repricing of credit. It can be liquidity.
Right.
People want to exit, and if you've got liquidity to provide that, you can actually get paid handsomely for providing liquidity into the marketplace. What's really important is that you're positioned the right way. If you're not, you don't have that capability to deploy that liquidity, then you can't take advantage of it.
The opportunity just flies past.
Correct, absolutely.
Yeah, right. Roy, another thing I took from the recent monthly was the fund took part in several domestic tier 2 deals. You and I have spoken about this many times. It's sort of your favourite place to play, if you will, and increased exposure to corporate sub-debt. Just take us through those 2 moves.
Yeah, so first of all, tier 2, we're just talking about this. The perfect example was, Tier 2 spreads probably were elevated by 40 to 50 basis points
Right.
during that April period of volatility. We were pretty lucky that not long after that, Westpac came with a Tier 2 deal. It was elevated. We purchased that deal because spreads were elevated to where they were previously. And that sort of deal has performed really well for us over the last 2 to 3 months. Similarly with the corporate sub-debt, we've been talking at Yarra now for a couple of years now that, this is the time for corporate sub-debt to take over. Yes, the AT1 market is disappearing, but AT1 sort of corporate sub-debt is actually filling the void of AT1. And only in May, when spreads were a bit wider, we had Horizon do a subordinated debt deal. We've seen a lot of energy companies come to the market to do subordinated debt deals. So that market's becoming a much bigger component of our fund. Today we're sitting at about 18% in corporate sub-debt. 12 months ago, probably would have been sitting at 8 or 9%. So you can only change your weightings based on the opportunity that the market presents as well, which is, and we do like that sector, corporate sub-debt, because if you're comfortable with the senior, getting paid 1.5 to 2 times over the senior credit spread for a credit that you're really comfortable with, investing down the capital structure makes a lot of sense to us.
Yeah, for sure. The outlook, Roy, from the monthly talked about credit conditions in Australia remaining robust, so good for default risk, spreads and liquidity. Just to round out, what gives you that confidence that that will carry through?
Yeah, so when we look at our forecast for growth in Australia, we're still running at around 2% for 2025-26. So that's, I'd call Goldilocks conditions for credit, right? So we don't like 4%, we don't like 0.
Yeah,
so
sure.
right in the middle is perfect for us. Right. So I think from a growth perspective, it's a tick. If we look at corporate balance sheets, especially investment grade, companies are in really good shape.
Yeah, they have been for a while, haven't
correct.
they? Yeah.
And in some ways, over the last 2 to 3 years, we've been generating really, strong returns in our credit funds without taking a lot of risk.
Yeah.
We're running the highest credit quality we've had. So, whilst we think credit conditions are really good, we think it's really good for IG, and we're sort of mindful of, if we are investing down the cap, into the credit structure and going into higher yield investments, you really do want to get comfortable with that company, and more importantly, get paid for that risk. And we just probably don't think it's the time to be investing in high yield at the moment, and we're still happier to stay up in that IG place. But conditions are really good.
Yeah. Roy, always a pleasure. Thanks for sitting down with Livewire.
It's great to catch up again.
If you enjoyed that interview, make sure to give it a like, and don't forget to check out the rest of the income series content available on the Livewire Markets website.